Well, let's start there. Let's talk about the winners first because that's more fun. But then I would agree that capitalizing on the losers is more common. So let's start with the winners. What's the miss that you feel like
So from
people
here
make?
on out, everyone's winners. 10 out of 10. The Whenever you make any investment, let's just say you have a normal like investing account, you have a Robinhood account, a Schwab account. If I make a purchase for anything at $100 and I ended up selling it for $1,000, the difference in there, that gain part when I sell is a capital gain. Capital gains rates, they kind of depend on what you've got going on. For our audience, the majority of what you'll see is, tax rates are like either 15% most commonly, or if it's a higher income year for you, it's going to be 20% of the gain. Whatever you put in is already yours. But the gain part, you're looking at maybe 20% in capital gains tax. There's another tax to be aware of, another bummer. Uh, there's this thing called net investment income tax, sometimes lovingly called Medicare surtax, and that's another 3.8% generally. So just in your mind, 23.8% of long-term capital gains, you know, that's what your tax rate is. If if you as an angel investor uh, invest early and you check, qualify, and you hold for the amount of time. I'll talk about all these like requirements in a second. But if you invest early enough when the company's small, a qualified small business, and you held for a certain amount of time, held long enough, and then you sold later, or like there was an acquisition and you got cashed out, something like that. If you meet the qualifications, that gain basically gets like erased or forgiven or whatever the language excluded, if you want to use the right terminology, up to certain limits. And so now you might not have to pay that 23.8% tax on the gain. So that's called qualified small business stock, QSBS. There's been a lot of talk about this. More recently, last year, it was a big topic because it made the OBBBA, one big beautiful bill act, and there were some adjustments to it. Um, Actually, like the rules got even sweeter and better for early investors. So that's the big one that everyone needs to know about by far.
And in your experience, because you're an active angel, you come from Silicon Valley, you're a part of Angel Group. Do you feel like many investors just aren't aware of this? Like I've been following this, I'm tracking this. We did a special episode when the Big Beautiful Bill published, kind of walking through some of those changes, and I'll include a link to that in the show notes. So to you and me, this is pretty common. Do you feel like most angels are missing this, not seeing, not knowing about QSBS?
It's a house divided. I never know. It's like 50-50. I'll talk to somebody and they're like, oh yeah, sweet, QSBS. And they'll just use it in like they'll use the acronym like in a conversation. And then I'll talk to the other half of people and they say, what is that? Maybe I've heard of it. Oftentimes they haven't heard of it. A lot of times maybe you've heard of it, but you have no idea if that's for you or not. And
Hmm.
that's the downside of like the tax code being as vast as it is. The OBBBA alone, yeah, QSBS got some like, it got some mic time or it got some spotlight, but there was also like 50 other things that got
Hmm.
were like on the table, right? So it's just hard to know like what to focus on. So I guess I'm just here to be the evangelist today. Like angel investors are certainly like they have a chance of qualifying as a QSBS investor, assuming you meet some of the main parameters, which I think we should definitely
Yeah, I
talk about.
definitely want to hear about those. But I mean, this is just to make sure it's clear. This is a huge deal because a lot of the time, this is the winners, right? These are the things that drive the entire return of the angel investment or the venture strategy, right? Is asymmetric outcomes with a few companies in the overall portfolio driving the vast majority of returns. And so to
Right.
give up 20 or more percent points on that gain to Uncle Sam versus potentially keeping that in the pocket on a 10 or 20 or 50 or 100 Xer, we're talking real value, even if this doesn't materialize on every deal, having it in place where it's possible to have in place There's
Right.
just massive implications for somebody's portfolio. So tell us a little bit more about some of the exclusions, and then how to like practically, how do I do this? How do I make sure that
Yeah.
all of my qualified investments are getting this treatment?
Yeah. So let's make sure that you know what it is you're actually aiming for. See if it's worth your time. Punchline, it is. And then it's like once you know what you're aiming for, and all your audience members, 10 out of 10, they're going to be winners. What do I do now? Right. So we'll talk about both of those things. So what's the carrot that we're aiming for? QSBS, again, you're trying to get your capital gains taxes excluded and up to certain limitations, right? So it's really just an incentive from the government. And this is all IRS federal stuff we're talking about. I'm not introducing state stuff because some states follow this, some states don't. Let's keep it simple. We're just talking about the IRS federal tax code. They want to incentivize early investors, venture and angels to invest in startups. And so that's when like startups, small businesses, qualified small businesses. If you get in with a qualified small business as an investor and you have held your shares for, I'm going to use the new rules from the OBBBA just for simplicity. If you've held anywhere from 3 to 5 years, at least you will get some sort of exclusion. If you hold for all 5, you get the full exclusion. How much can you potentially exclude? Um, the numbers, the number is really big. It's up to $15 million of your capital gains just kind of removed, right? So that's a big number, right? These are like venture fund level like numbers, but so that's maybe like an 1,000x sort of like return for typical angel techs.
So for a typical 25K angel check, it's never gonna even at 1,000x, right? That's pretty good. You're gonna keep a lot of those dollars potentially if you're able to maximize these exclusions. Is what you're saying.
That's right. That's right. Yeah. So like let's say the average check size is $10,000, you know, and you hit a 10x, like a 10 bagger, and you sold for 100K, that $90,000 now does not, you're not going to get taxed on that $90,000, which definitely affects your after tax returns.